what's happening on our end. And good morning, everybody. Good morning, Harry Bloomfield. How are you doing? I see you're here with us in Montreal. I was just telling Andrew that I'll ask him in a second how COVID is influencing, is handled in Toronto, because I know in Montreal, I spoke with a friend of mine that told me that things aren't looking good, that after 2 weeks, because Montreal started 2 weeks before the US, it was important to understand what's going on. And he said over 50 schools have at least one case of COVID, which is very, very bad. And I hope it's not, what's waiting for us. Before we'll touch that, let me just introduce Andrew. Of course, he will talk about his life and work in a second. Andrew Branton is the CEO and co-founder of Turtle Creek. And I believe we had the honor of having Turtle Creek support our events in the past. Mr. Brenton founded and was the CEO of the private equity subsidiary of the Bank of Nova Scotia, where he made controlling investments in dozens of Canadian private companies. He was the head of high technology investment banking practice of Scotia Capital in the early 90s. And prior to that, he was founding member and managing director in the firm's mergers and acquisition practice. He joined McLeod Young Weir, the predecessor of Scotia Capital, in '84. And he's here with us today. So first of all, good morning, Andrew. How are you doing?
Good morning. I'm doing well. And you mentioned issues with COVID, and I think just before we started, you were asking if we're back in the office, and we actually are. I'm in my office speaking to you, but we'll stress that we're all wearing masks, other than if one is in one's own office. So the investment team's actually meeting now in our boardroom, and they'll all be wearing masks. We just actually had a virtual call with one of our companies that does factory automation globally, and so that was a really interesting conversation about how they're dealing with issues around the globe. I think further on in our discussion, Denny, we would be happy to touch on how a lot of our companies are dealing with the COVID pandemic in their business.
How are schools do you know any idea in Toronto how they manage it? Because I know in Montreal it's not looking so great.
So, there's been a bit of an uptick in cases in Ontario. We've been following this globally since, I guess, really since the beginning of the year, looking at, every country, whether it's Israel, Sweden, and then, of course, in Canada and the US. And Ontario's done a pretty good job generally of keeping the caseload down. It has ticked up in the last few days. The public schools are just opening now. So we'll see what happens. But generally the cases in Canada have been, if you think of it in terms of the population, have been pretty well managed. British Columbia was really a leader in dealing with the pandemic at the very beginning. So,
got it. Thank you. So you have an uncommon background for a public equity manager. So if you can tell us your experience prior to Turtle Creek, I mentioned it briefly, how it led you to launch your strategy, I believe over 20 years ago. And maybe I'll also ask, does your earlier private equity experience influence your investing style?
So for sure, look, I think that, the way to think about us, and I'll stress it's myself and two founding partners, Jeff Cole and Jeff Abel. We were working together actually in M&A at the beginning. They're somewhat younger than me. I actually interviewed them both as they came into the firm. So when I set up the private equity business for Scotia, Jeff and Jeff were the two of the key people that I picked to be part of that partnership. And that private equity business, importantly, I think, was a greenfield operation. In other words, we had the bank's balance sheet, we had the bank's support, but it was really an independent, go out, do private equity, see if you can make money, as opposed to any kind of cross-selling efforts inside the bank. So it was a great opportunity. We actually had very strong returns. But as we were doing that, we kept seeing better companies, better managed companies in the public market where we could get invested at a much cheaper price. Now that may sound kind of counterintuitive. A lot of people think that prices are lower in the private market. That is not our experience. And I think that many participants in private equity today are quite admitting that they're not able to get invested at the prices you can get invested in the public market, as long as you pick your spots. Now, you can't get control of that public company at that price, but we don't sit on boards. We're not activist shareholders. We are engaged shareholders, and we're not shy to give our views to our companies on things that we feel we can contribute. But essentially, we got pulled away from private investing because of these companies we were seeing in the public market, and we thought, let's go about the job of trying to identify the minority of public companies that are really well run, well governed, and focused on their shareholders for the long term. That's a list, a checklist that most public companies don't pass, but we don't need to find thousands of public companies. Today, we've identified and have a view of value on about 100 public companies. And today, in our main fund, we own 28 of those. So when you think about the thousands of public companies, we first just don't even dig in on companies that don't pass those tests that I mentioned. And then we're very valuation focused. And to your question of, what did we bring from private equity to the public market? I think partly it's an appreciation of how complicated the world is, how difficult it is to run a company. And because we were control investors in private equity, because we sat on boards, we come with an appreciation and an understanding of that. And when we sit down with management and we talk to management, like this morning, I mentioned the factory automation company, 3 or 4 times, the CEO said, literally, he said, it's really great to talk to you guys because you know our business so well, so that he can go deep on issues that his comment was with the other shareholders that he has calls with in this environment, he isn't able to go deep. So I think it's an appreciation of complexity, and yeah, those are some of the things we bring from that private equity background.
Now, I know you always stress the fact, and we'll talk about that also later on, that you do things differently. So maybe you can share a little bit of Total Creek's philosophy, what sets you apart from traditional value investors, and do you consider yourselves value investors, actually?
Yeah. No, look, it's a great question. We actually have a corporate motto, if you will. It's now on the back of our business cards, and it simply says a different kind of value investing. And I do think we're different than what I'll call the traditional value managers. Before the lockdown, we were actually in Europe, and I presented at a conference there. It's the first time I'd done that in Europe, and that was the topic. And I was a little nervous because it was late in the day. There had been a lot of portfolio managers talking. It was a value conference, and I said, "Look, I think we're different. Here's how I think we're different." And by the end of it, I was actually voted best content for that conference. So I didn't offend anyone, I guess. So the ways that we think we're different, we describe our process as 4 steps. The first couple would be maybe more what a traditional value manager would do. Try to identify terrific companies, which every investor is trying to do. Then the second step is the valuation work that we do. And then the third and fourth step, though, I think are quite different, and most managers that we've ever listened to don't do those steps. So if I could just go back to step one, we're trying to find terrific companies, as I was describing, like every good value investor is. But we're, in effect, looking for something different. And that difference is, as a bonus, a company that may not be well understood by the public market. And because it's top of mind, this factory automation company, it's Toronto listed, but it's global in their operations. It's called Ats Automation. There's only one factory automation company listed in Canada. And in fact, I think ATS is unique in their strategy globally. So when the analysts look at that company, they don't really know what to compare it with. And so we're really drawn to those kind of companies. I think that by and large, the companies we own there aren't easy comparables, if you know what I mean, in the public market. We view that as a positive in that the chance that the company can get mispriced in both directions. And we see that. So that's a difference, I think, in that first step, looking for companies that the market may not be able to get their head around. Now, I'll stress, we're not looking to invest in companies that we can't get our head around. So if I think of biotech and drug discovery, we would never look at that sector for a whole host of reasons. So they have to be manageable and understandable by us if we do the work. And then in that second step of trying to come up with a view of value, I think a really important difference with us is that we're trying to get it right. We're not trying to be conservative. And when I listen to traditional value investors, they always stress, the classic, of course, is the Ben Graham nets that don't exist anymore. But there's always a stress on how conservative the manager is in their thinking and in their valuation and their forecasts. That we're not doing that at all. And if I'll use this factory automation company again, we think there's a lot of growth that they have. They've addressed, they're mainly focused in the healthcare sector globally. That's a change over the last decade. They used to be much more automotive and transportation. And so watching them evolve has been a fascinating process. And and as I say, they have growth and a lot of growth. They also have the opportunity to acquire companies. And when we forecast all of that, we can end up with what someone else might look at and say, that looks like a hockey stick forecast over the next 10 years. But in fact, this company has accomplished what we've been forecasting and then some, and we think they will going forward. So really emphasize that we're trying to get it right. If a company is a true platform business, and we think we have a number of those, about half the portfolio is today invested in what we would call platform companies, not roll-ups like a Valiant Pharmaceuticals, but a true value-added platform company. And if they have created value through acquisitions in the past and they have a big opportunity set and they're telling us they're going to keep doing it, we think it's absurd not to build that into our forecast. So that's the difference in our forecasting versus what I call traditional value investing. And we move to steps 3 and 4, we just don't see others doing this. And what this is sizing a position correctly when we first add it to the portfolio. And we don't change our holdings that often, 3 to 4 a year perhaps. But when we do add a company, we have a way of deciding whether it should be 2.5%, 2.9%, 3.2%. That's important because once we've done that, we move to step 4, which we call continuous portfolio optimization, which logically means if we've sized it correctly and the share price declines and nothing's really changed, we believe we should buy stock to make it a bigger percentage. But equally and symmetrically, if after initially adding it, the share price goes up and nothing's changed, we believe we need to sell shares to over time make it a smaller percentage of the fund. And our long-term returns are a combination of picking those really good companies that create shareholder value, but they also come from this process of changing how much we own. And I'll just use Ats Automation as a reference. We've owned it for over 10 years now. I think a buy and hold for that company is in the mid-teens. So in other words, buying and holding this company has been a terrific place to be in a buy and hold sense. They've created value for shareholders. So think of that being in the mid-teens. Our returns have been north of 30% in that company to date because of this activity, because we own more at cheap prices and trim it at higher prices. And like I said, that step 3 and 4 combined, we don't see anyone else doing that. And a lot of groups who evaluate managers tell us that they've not seen anyone else do this. And I think partly your question earlier about private equity, it may be that because you can't do that when you're in private equity, we just think this is such a terrific lever or tool in the public market, if it's done right, that we can't imagine not doing it, if you know what I mean.
Yeah. So you spoke about some of the actually points that I wanted to ask, how you find great companies, the qualities you look for, maybe in management or business. That's something that maybe you can talk about. What prompts you to add a new company, to sell a company, how long you usually hold on to your investments. So that maybe you can address that as well. And then how important is the access to the management? Because obviously that's a major part of you finding the right deals, is the right management to the more interesting companies.
Sure, and I hadn't intended to use Ats Automation as a case in a way to answer these questions, but it's top of mind because we just had a video conference with them this morning. And it actually is a terrific example of what we're doing over a very long period of time. So they're based in Cambridge, Ontario, which is about an hour drive from Toronto. It's near the University of Waterloo, so it's a tech center. And we drove down to see that company. Gosh, it was in the early 2000s, so think 18 years ago. And we met with management and we did not understand their strategy. It didn't make any sense to us. The founder had passed away, and I think it's a company that for some years had lost its way. And so we very simply just after that day came back, closed our books, didn't do any more work on the company. It's back to that example of, threshold matters for us, and this company didn't pass those initial tests. So it didn't matter whether it would turn out to be cheap or not. Some years later, we followed a proxy fight. We were not involved. And the board was changed, management changed. We went back down and met with the new CEO and CFO. We knew them from a previous investment, so we had a high regard for them. And then we started doing work and first bought the company in early 2009. And I've touched on how we've improved upon a buy and hold since that point in time. A few years ago, the board announced they were changing out the CEO, which initially we weren't sure was a good idea. But talked to the chairman, talked to the larger shareholder. We were the second largest shareholder. That shareholder was and still is on the board, and became comfortable. They were trying to do the right thing. The CEO that we knew had done a wonderful job of turning the business around, fixing it, but they didn't think he was the right person to take it to the next level, to really grow it globally. And we didn't necessarily know whether that was right or not, but we trusted at least the board was trying to do the right thing. And that's all we can ask for as an outside shareholder. And now with the new CEO having been in the seat for about 3 years, I think, he absolutely is the right person, very impressive. So that's a journey that we've gone on with this company for close to 20 years, not owning it and now owning it. And how long do we plan to own it? We'll own it forever as long as it continues to pass our criteria. But the other important point, as long as it's cheap enough to be in the portfolio. So your question also was, when do you take out a company? Once in a while, it's because we think a company has lost its way, or we were wrong on it. That doesn't happen that often, not as often as it happened 20 years ago, for example. And it'll happen again, but that's actually pretty rare. What happens is, the company's share price goes up and nothing's really changed. And so with Ats Automation, as you can imagine in this environment, they're winning lots of COVID-related contracts on the healthcare side. That's 65% of their business and growing. I could see a scenario where the market gets really excited about this company and the share price goes to a level that it doesn't make any sense for us to own it, and it'll just get out of the portfolio. But it's important to understand it'll happen in little bits. In other words, we're extremely continuous in this process, and we buy little bits as it falls. If it falls a lot, we buy a lot, and equally, we do the same thing if the share price rises. So we'll follow this company forever, but we may not own it at points in time.
Continuous portfolio optimization. So can you talk a little bit about that?
Well, I think, so I've talked a bit about it with using Ats Automation. As I said, I wasn't planning to talk so much about that one company, but I think it's a great example. But if I can do this right, let me share a screen, and then I've got an example here. And then if I do this, yeah. So it's actually not the one that I was looking for. Oh, here we are. So this is a company we still own today. It happens to be head officed in Waterloo, Ontario. Although the CEO is American, I really think their functional executive offices are now in the Valley in California. They're terrific software business. They've been highly acquisitive over the years. And so this slide really captures those 4 steps that we follow in our investment process. So think of us trying to identify terrific companies, all the things that I mentioned. This company absolutely is shareholder focused. As I say, they've created a lot of value, somewhat a little bit through organic growth, but mainly through acquisitions. There's a key director there who's been on the board for over 25 years, runs his own software company, and I think has kept management on the straight and narrow of not overpaying for acquisitions and not getting enamored with revenue synergy, which often doesn't happen. And so there are 3 things on that slide. The green line that steps up and sometimes steps down over time, that's our view of value at any point in time. The black line is the share price over the last 20-some years. But then importantly, the third thing is this, I don't know if you can see my cursor, but is the gray background, and the left y-axis shows the percentage weighting in the fund over the years. And you can see actually that, of course, it's fluctuated a lot, the weighting. You can see in 2000 or during the dot-com, there were 3 different times we did not own any shares. And then even in the credit crisis, we did not own any shares. But otherwise, we've been a shareholder, and today it's actually a below average weighting at around 3.5% weighting. And I'll also point out that with the share price, it's on a log scale. So when you first look at the slide, it may not look like the share price has been all that volatile, but it really has, especially in the first number of years. And so you can see how, in essence, when there's a bigger gap between the share price and our view of value, we own more shares. It's a bigger percentage in the fund. When there's less of a gap, we tend to own less. Now, of course, you can't see what's going on in the rest of what's happening to the rest of our holdings. So, for example, in the fall of '08 and the credit crisis, the reason we took it down from about 3% weighting or so, 2.5% weighting down to 0, wasn't because the share price went up. It was because the share price actually didn't go down and everything else we owned went down. Some went down a lot. So again, it's the relative valuation of the companies that we're following, which drives how much we own. We think of this as not a way to enhance returns, although it tends to happen over time. We actually think of it as a de-risking process. So one way to think about it is it's that classic margin of safety. So in that regard, we are absolutely a value investor focused on present value of cash flows. But our belief is the bigger the margin of safety, i.e. the bigger the gap between the share price and our balanced view of value, the less risky the investment is. But the corollary is the higher your likely return from that price point going forward is. So as we like to say, you know, risk and return can be inversely correlated. You can actually earn higher returns by taking lower risk. And that's what we do. Think of those 100 companies, any one of which we would own today. We own what we think are the 28 cheapest. We're really just trying to create the biggest margin of safety from the companies we've identified. And so that de-risking process has taken if you look at the first bullet under the slide, a 13% buy and hold. So, you know, think of our process. We definitely have found a company that's created shareholder value. That over 21 years, if you simply bought and held this stock, you'd have earned a 13% a year annualized return. We've earned a 57% annualized return because of taking advantage of that volatility. And I'll also point out much higher returns in the early years when there was more volatility, for example, in the .com. And if you look at the slide, a lot less volatility in the last few years, which simply means we've done less with the portfolio. So at core, we're a buy and hold unless something changes, i.e. unless the share price changes.
I want to talk a little bit about the markets and jump to that. So first of all, you invest in both US and Canadian markets. Would
Yes.
Would you look at European companies as well, or you're focusing around here?
So the plan, what I would say is we will at some point look at European companies. We started, we're Toronto based. We started as 3 people on the investment team. We're now up to 12 professionals on the investment team. We, by the way, have never had anyone leave the investment team. So there's been no turnover. So when we first started, we thought before we wander off to the US or anywhere else, let's process through all of the Canadian companies. And we're really focused on what I'll call the mid-cap space. Is that, I think you'd ask the question, is access to management important? And I think you can probably, it was implied in my answer, but I didn't answer that. I'll say it now. It's critical. It's critical for us to have time with our management teams. Think of COVID hitting North America, well, Europe and then North America, and in early March, the market crashing. To be able to get on the phone company by company and talk about their liquidity. I mean, we always focus on balance sheet strength, but you especially think about it in the middle of a pandemic. Those things are really critical. And so, but in terms of our geographic focus, again, we thought, let's meet everybody in Canada. And then about the time of the credit crisis, so 12 years ago, we thought it's really diminishing returns of trying to find another company in Canada. So for the last dozen years, we've been doing that same process in the US, and we've found some remarkable companies that are as good as those Canadian companies that I've referenced. And so now in our main fund, the US content is actually a little over half of the portfolio. So to answer your question, we're absolutely across North America in terms of companies. That's where their head offices are, and this is where they're listed in the public market. They're typically global in their operations. Mm-hmm. So for sure, at some point, we will look in Europe to try to find similar companies that we found in North America.
So for people, I see here questions about the markets now coming up. For people less familiar with the Canadian market, public market, maybe you can give a brief description of the landscape. Do you think the Canadian market is less efficient than the US or any other market? How do you see the differences, if there are, between the US and Canadian markets as you work in both? So that would be my first question.
You know, it's interesting. So we don't see massive differences. I would say that, you know, when a Canadian company, Alimentation Couche-Tard, great global business. When a company gets to a certain market cap, I think they're 30, 40 billion, they're only listed in Toronto. We don't see a valuation difference between that company and the US or an efficiency difference. And by the way, they have a lot of US shareholders. But I think perhaps at the smaller size, again, come back to Ats Automation, the analyst who covers it in Canada, he'd be the special situations analyst. There's only one company like Ats in Canada. And so, you know, maybe there's some inefficiency there. Another longtime holding of ours called TFI, it's actually headquartered in Montreal. It's a trucking company, remarkable business that's grown from 100 million in revenue when the CEO took it over 20 years ago to being the 6th largest trucking company in North America. He actually just announced a major acquisition in the US this morning. They've listed now in New York this year, so maybe it's a bit of a case study or an example of now that there are comparables and the analysts are covering in the States, for sure I think it's gone through a re-rating, you know, higher multiple perhaps given the comps in the States. So we see that in pockets, but generally I wouldn't say there's a profound difference in call it valuation. The one thing that we observe is the freneticness and, you know, if I can say the viciousness of the reaction in the US. The fearless reaction of shareholders or hedge funds in the US compared to perhaps, and maybe that's a different in national personality. So, and we think that's actually exciting because if you think about our process where we take advantage of market overreactions to events, to a quarter, I think for sure it's a more profound reaction in the US than in Canada. Now, an academic would say, you see, that means the market's more efficient in the States. But of course, that reaction, the academics assume that every time that reaction is correct. So for sure, I think there is more activity in the US capital markets, but I'm not sure they're getting it right. It's just more reaction. So that's how I contrast it. And then the only other difference, I guess, and it's more with respect to us, we're more likely to find the next you know, terrific billion-dollar market cap company in Canada than we are in the US, just because we're on the ground here in Toronto. We're always taking meetings with smaller companies that, and so those differences for us are maybe more of our continuous portfolio optimization with the US market, but maybe some, if I can say, use the word alpha, from identifying some smaller companies as they're growing. There aren't many examples of businesses that you know, grow and continue to grow. We have many of them in our portfolio, and as I say, we're always on the lookout for the next one.
We have lots of questions, but I'll get to them. But maybe One question is, what's your minimum private investment size?
In the sense of an investor coming in?
I think they're asking when you invest in a company, but maybe answer both.
Okay, so, well, for us, our minimum investment is $2 million for an investor, just if that was the question. In terms of the minimum investment into a company, it's really, the way we think about it, so today we might have a 0.8% of the fund in a company, because we think that's the right weighting. And there would be some candidates that are saying, hey, I should be 1.2%. We're not going to switch. We'd be changing our companies at the bottom end of the portfolio too often. So our trigger to really say, okay, do we want to add this company, typically is a 2% or 2.5% target. So if we have a company that, in a sense, has its hand up, because remember, we have these other 80 companies or 70 companies, they're in the spreadsheet, we have a view of value, there's a share price. If the share price drifts down and it's starting to say, I think I should be in your portfolio at 2.5%, that'll trigger a beat up session, a conversation. We'll go back at management. And then if it merits it after the beat up session, we haven't changed our view of the forecast, then we would add it at that 2 or 2.5% amount. So that's the trigger. And then, by the way, we would kick out that 1% holding to maintain a fixed number of holdings in the fund.
And you invest in mid-cap. Why mid-cap? Why not small, large? And also, if you can talk about what everybody are interested, I believe, is how COVID changed or not your portfolio.
Yep. So why mid-cap? I mean, we haven't had a great experience in small cap, what I would call sub $1 billion in the Toronto market. And when I say not a great experience, we've made money, but the returns of that component hasn't been as good as what I'll call the mid cap of $1 to $20 billion. And I think there are a bunch of reasons for that, but one is I'm not convinced that as a shareholder, one gets paid for the risks that you're taking with smaller companies. And so what we like about the mid-cap space, these are significant companies. These are companies that, that are meaningful global operations. They've been de-risked if they're well managed. And we don't see any difference in valuation. If anything, we actually find at times, company by company, it's not a broad statement, but very attractive valuations in the mid-cap space. And so, and back to that thought, we need to have access, we want to have access. So we like the idea with these companies, we might be a 2%, 3%, 10% shareholder in the company. And interestingly, even with our US companies, let's say it's a company with a 10 billion market cap, we manage $3 billion. So if you do the math, we might only have $100 million worth of their stock. That's actually meaningful. It's interesting how broad-based the ownership is in the US. And with the rise of passive investing, we often will show up as a top 10 shareholder. And so that ability to, do you have a follow-up call with them after the results? When they're at conferences, we can get a one-on-one meeting with them. That ongoing dialogue, the example of the automation company this morning, just having an hour-long conversation with them. They did a group presentation yesterday. Of course, we were part of that. But then to have an hour-long one-on-one conversation with them, to us, that's really important. Our second largest holding, it's Vancouver-based, when the CEO comes into the city, and he's not coming to see investors, but maybe on his business, he'll reach out and we'll get together for dinner. Those things for us are really important given our background in private equity. We try to develop the same level of knowledge of our companies that we had when we were private investors. Not sure I answered all of that question. Was there something that, oh yes, you were then talking about COVID and how that's impacted our portfolio. Well, first of all, I'd say it has not changed at all our approach. So what we did when the pandemic hit is step one was balance sheet, and I've mentioned that already, making sure that no matter how bad it was going to be, imagine a full year lockdown in Europe and in North America, which of course has not happened and I don't think will happen going forward, regardless of a surge in cases again, that our companies, every one of our companies would make it to the other side. And we quickly got comfortable in conversations that was the case. The next thing we did was, are any of our companies impaired permanently? Are they profoundly changed as a result of the pandemic? Is there a change in human behavior that, if not permanent, is long lasting? And we don't own travel and leisure companies. We don't own airlines. We don't own gaming, like casino companies. I think if we did, we would have to really turn our heads to that issue. But we concluded that none of the companies in our portfolio were permanently impaired in any way. In other words, many of them, of course, are making less money right now than they were prior to the pandemic. One of our large holdings is a supplier of equipment for restaurants, so cooking equipment. So imagine when many of the restaurants are closed down, their sales are lower, of course. But we think, in fact, that company comes out of COVID and the pandemic and the recession stronger than it went in, and that's a theme across our portfolio as companies reported their second quarter results. I think, I can't remember that ever happening before, but every single one of our companies met or exceeded our expectations, and I think in virtually every case exceeded the market expectations. So the nimbleness, the flexibility, it's one of the advantages of making sure you own really good companies. The ones like this company, Middleby Corp, that makes both residential and commercial cookware. It's been remarkable how they've handled things. And as I say, most of our CEOs have literally said to us, we're coming out of this stronger than we went in, sometimes because the competition stumbles, and sometimes because of things that they've done. Our largest holding is the biggest plastics packaging company, not just packaging, plastics company in the world. And their biggest segment is health, hygiene, and safety. So they have 300 plants around the world. They make the non-woven plastic for surgical gowns, the N95 masks, the Clorox wipes that everyone's using. So that part of their business is on fire, of course. And overall, I think that's one where they've net benefited from the pandemic. So, a lot of people worry about the market and what the market's going to do. I'm talking about the stock market. We just focus, our attitude is, and I say this to our investors, we just own companies. It's not our fault that they're public. And so you get of course, a market crash in March, our unit price is down, but then our companies report and the market stabilizes and we fully recover that decline. And we've seen that over and over again. And of course, if you imagine our approach, we've taken advantage of that decline and recovery to rebalance the portfolio. But no change to our approach, and I think no impact in any lasting way on any of our holdings.
And you don't think the private markets are more expensive, the public markets, than the private equities? And in the private equity, we hear about returns of 30% and such. Do you think it's possible to achieve that also with public stocks?
Well, you might hear about 30%, but they don't actually make 30%. And you have to be really careful in private equity when people quote IRR. I could give you, you know, it was interesting as we do attribution analysis, and this is going way back, but some groups in the States just wanted to look at, you know, have our returns come from a couple of home runs? And the answer is no, given our approach, we never have home runs. But we have an investment with from the .com period with a 200% IRR, but we lost money. And to say, how's that possible? 200% positive IRR and we lost money. What happened is we invested in the company. Within a few weeks, the stock price doubled. This was early 2000. It was a small holding. We sold half of the position in the face of that rise. And then it was such a small holding at that point, and we were just 3 at the time. This would not happen now. It kind of didn't get a lot of attention because it was less than 1% of the fund and we were focused on other things. And then over a year or two, it declined. And when the bubble burst, the share price really fell. And when I say the share price doubled, it didn't quite double. So we actually, the other half, we sold such that when you add the two together, we lost a bit of money, but we had a 200% IRR. So if you think about private equity, and groups have learned to look at multiple of invested capital as opposed to IRR, because in private equity, it's pretty easy to manufacture IRRs where you know, draw down money and then you return a bunch six months later on that investment to your investors. So I don't think the returns are there if you think about it from that standpoint, and the data would show that. So top quartile might be high teens to 20%, depending on the vintage year you look at. But more importantly, the multiple of invested capital is, I can't be precise on this, is more like 2 to 3 turns for a fund. Ours is much, much higher than that when we think about our multiple on invested capital over a period of time. And I hear this all of the time from institutions and some of our family offices. And I heard it in March, where they said, you know, I have to sit with a bunch of cash because I now think my private funds are going to do capital calls. So the IRR that they're calculating is on the money they drew, but people are sitting in cash for their commitment. But no, I think that I can't speak to the broad market when I read about 20 times plus PE multiples in the S&P 500. I think that's pretty high. All I can speak to is our portfolio, and right now it's sitting at less than 10 times PE with a lot of growth in those earnings. So I don't think you can do that in private equity. And the best, you know, current example of this is, I mentioned the plastics company that's our biggest holding. A year and a half ago, they purchased and outbid Apollo. So Apollo is one of the major private equity firms, high quality firm. They matched price essentially that Apollo paid, and they're the strategic buying a UK company that is a mini version of them, not so mini, it's 60% their size. They used all senior debt to fund it. And the multiple that they paid and that Apollo was willing to pay is higher than this company is trading at in the public market today. I mean, another way to state it, Apollo would kill to be able to buy Berry Global, this plastics company, at anywhere near the current traded share price. They just can't do it. They'd have to pay such a premium if they could actually get it. And we're just sitting saying, we own this company. The market's giving it a low multiple today. At some point, I think it'll give it a much higher multiple, but it's okay if it doesn't, because they're generating so much cash. Soon they'll return to buying back shares. But it's trading today at 7.5 times earnings. And like I said, Apollo was willing to pay 9 or 10 times EBITDA for this standalone European company whereas Berry Global's trading at less than that today in the public market. So no, I think that, you know, private equity is a lot more competitive than it was 20 years ago. And I hear that from people who are in the space. Even though it's been a long time since we've been in it, we actually know more, even today, more private equity investors than we do public investors, given our background. And in the public market, as you can maybe sense, we tend to go it alone on things.
Now, before I ask you your returns, how well you guys been doing, let's talk about risk and return in the sense of, I believe when we spoke, you mentioned you're not as worried about volatility, but I want to hear what you think about that. And then how do you determine how risky an investment is? And what's the trade-off really between risk and return when you guys look at investments? So maybe we'll start with that.
Sure. So I don't think volatility has much to do with risk. I understand why it gets used, because what else are you going to use? Because and look, one of the great insights in the 20th century in finance was to say you can't just look at returns. You have to look at the risk that was taken to get those returns. And that's an obvious thing to state, but that wasn't conventional thinking 100 years ago. So then the issue is, well, how do you determine what risk is, or how risky an investment is? There's only one metric that an outsider, meaning an academic, can use to try to assess risk. And it's, well, how much does the marginal price of that investment move around? And if you believe that the market's getting it right all of the time, then it's okay to use volatility as a risk metric. But it's absurd to think that that's happening. It just is not. We see that on a daily basis when we see the companies that we know, and you look at how the share price moves around, it doesn't make any sense. It is thousands of people making their own independent choices, which draw, and all of the emotion and the panic in the pandemic and the overreaction. It's human nature, and that'll always be the case. And I love the line from Robert Schiller, who said, you know, the greatest intellectual error in economics in the 20th century was to say the markets react to every new piece of information, which is true, but then the intellectual error was to say, and it gets it right. And he said, that's not logical at all, and he's argued strongly against the efficient market theory. So I don't think volatility is risk. You know, I'll use another Canadian example. Dollarama is a terrific specialty retailer here in Canada, and now in fact a little bit in Central America. I went back, we wrote about this in one of our quarterly commentaries. The share price we thought it was fully priced. It was not in the fund. Great company. A short report came out. This was a few years back now, you know, arguing a bunch of things that we didn't disagree with. In other words, is there more growth, which is why we didn't own it in the portfolio, caused the share price to really fall. And to the point where we thought it then belonged in our portfolio, and we made it 3% of the fund. Over time, the share price recovered. It is not in our fund today. If the same thing happened again, it would probably end up back in our portfolio. When you look at volatility prior to that short report, the volatility of the stock was very low. And yet, when the volatility went up as a result of that short report and people worrying and the share price being more volatile over a 6-month period, you know, an academic would say, see, now it's riskier. The stock had gone from 50, I'm not going to get the numbers exactly right, but let's say 50 down to $30. From our standpoint, now it's a lot less risky. The business hasn't changed. By the way, there were some things in the short report that were not correct, and it was a lot of mudslinging. And that is all passed away now. The stock is back trading at a premium multiple. And like I said, we don't own it. Buying it when there's that big margin of safety, that's avoiding risk. I think actually, if you think of the companies that we own, the risk that any of them go bankrupt is vanishingly small. They have strong balance sheets, they're well run, they all make money, they all generate cash. The risk is that you're in an investment and you look 10 years later and the company's done fine and your share price isn't much higher, that you haven't earned decent returns. So I think, once you get past the risk that you own companies where you're going to lose your money, then the biggest risk is what we call valuation risk, that you own a great company, but you own it at a great price.
And we almost an hour here, and we have some at least two important questions I want to ask. But maybe before that, I'll ask you, how do you explain, and this is not something we talked about, but how do you explain the fact that with everything that's going on right now, Chapter 11s and unemployment and COVID and no stability and not even knowing what's the future is got, even if this is over now, which it's not, but even if it's over now, what are, the chain reaction haven't started yet. Children that are leaving schools because they cannot pay universities, everything, this whole huge chain reaction that probably awaits us. How do you explain the market stayed relatively unharmed?
Well, it was sure harmed in the short term, but to your point, has basically fully recovered that decline. I can explain it on our companies. As I described, it has been remarkable how they have done. There's a company that is one of our top holdings that I haven't mentioned that is one of the two public, really it's a duopoly in the US, collectors of commercial, of bad debt. I shouldn't say collectors. They're not a collection agency. They purchase portfolios of bad debt, credit card debt, from banks and card companies. Their results have been off the charts. I mean, it's been remarkable. Now, they didn't expect that because they've never lived through a pandemic before. But, in the short term, we all know what's happened. The government correctly, I think, in Europe and in North America and elsewhere, I think, but I know about Europe and North America, have done all of the right things, classic Keynesian response to a demand shock caused by a pandemic. It's not anybody's fault, as opposed to the credit crisis, it was the banker's fault. And so in the short term, people they're just shifting where they spend their money. They're shifting on what they do. They're not traveling, they're improving their homes. And so that's been a short-term factor. We could get into a long debate. What are the long-term consequences of QE, QE2, expanding balance sheets? That's a very complicated issue that all the people who were convinced that it was a disaster to do QE 10 years ago are still trying to figure out when that's going to be a disaster. So all we do is we don't think about the market, we think about our companies. And I think it makes complete sense that our portfolio has fully recovered from the market crash. I will, and Denny, I'll forward this to you afterwards, and anyone on the call who'd like to listen to it. On the weekend, I listened to a new Monk debate. So those of you who know Canada, Peter Monk started this terrific debate series years ago, one every 6 months. They're obviously not doing them right now, but they have podcasts. And there is this very civilized, intelligent discussion between two leading scientists that are right in the middle of COVID. One arguing, the proposition is, has the scientific community overreacted to COVID? And there's a lot of hard numbers in it. There's a really good discussion back and forth. I think if you come away from that, the worry or the concern that we should be or will be going into any serious lockdown again would be dissipated. And so I'll just encourage anyone, if you're interested, to listen to that. So I look at this, and we've paid a lot of attention to the pandemic. I don't think there's massive economic risk now on a going forward basis, given the government response. I guess it's a long-term risk of, is there going to be inflation? How do the governments handle these higher levels of debt? But that plays out over a very long period of time as opposed to the next year. So I think maybe from that standpoint, it's not crazy that the market's recovered. And the other thing to keep in mind is the alternatives that people have. I mean, I had a call with a group that does a lot of work with us in Canada, and with their investors, they're increasing their allocation to us because they're looking at the alternatives. And I looked at this recently. We don't play with our discount rate, so we don't, because again, we're just thinking what's the relatively cheapest company. It doesn't matter whether we use a 10% discount rate or a 9% or 8%. So we haven't changed our discount rate since we started 22 years ago. But I just looked a couple of weeks ago, the US 10-year bond was 5.5% when we started in late 98. Today it's 0.7 or 0.6%. That's an extraordinary, that's been an extraordinary tailwind for people who own long bonds, but that tailwind of course is gone now. And so I think partly, you know, as investors, when people are looking at alternatives, man, I don't want to suggest that it's justified, because I don't like 25 times PE multiple holdings. We don't have any. But perhaps it's not an insane multiple for the public market, given that the alternative is to put your money into German bonds, which have negative rates.
And so before I go to some questions that are coming here, can you share your returns, how they've looked like in the last 5, 10, 20 years? And then if we're looking forward, I think you talked about that a little bit, but do you think after COVID, we'll be able to outperform again? You know, I guess people are also worried that there might be another pullback in the market. So your returns so far, and then looking forward, if there are opportunities here to invest.
Sure. Well, since we started, our returns we've had compounded returns of around 20%. But if you recall my comments about the .com, I don't actually like. I mean, since then, if you think in the last 20 years, the last 15 years, our returns have been in the mid-teens on a compounded basis. And the other thing that jumps out at me when I look at that is how consistent the market returns have been if you give it a long period of time. Like they've been 7% since we started. They've been 6% in the last 15, 10, 20 years. So, you know, think of us, if you throw out those first couple of years, not because we were a small fund, but because the market was crazy. And as crazy as things might have seemed this year, or there are pockets of craziness in the market, maybe always. Remember in Canada, there was the marijuana stocks a couple of years ago, which we never, of course, looked at, the Bitcoin noise in Canada and the States. So there are pockets of craziness. The whole market was crazy back in 99 and 2000. And so we captured returns from that. If it happens again, we'll, I think, capture really good returns because of our approach. We were out of anything that was .com inflated well before the top. So I really think park those. Otherwise, it's been, you know, actually pretty consistently double-digit, getting into the mid-teens returns. And when I look at our portfolio and the amount of earnings that they're generating, the quality of the companies, and like I said, that I think, if anything, in many cases, our companies, like the plastics company, actually benefit from the pandemic. People realizing all of the good uses for plastics. They don't make straws or plastic shopping bags and things. No single or water bottles. The things that you could validly say we should be not using them, or at least let's try to find a way to recycle them. So I have trouble, given enough time, seeing scenarios where we don't get ourselves into double-digit returns, and we've consistently outperformed the market. Not always in, of course, a 1-month period or a 1-year period, but the more time you add, the higher percentage of cases where we've outperformed. And I think it's because we don't get distracted. We don't chase things that are running. We're actually going the other way. And in this environment, when people ask about if the market's frothy, there sure seems to be a lot of froth on the software side. Open text aside, we basically don't own, there are some fantastic software companies that we follow in that 100 companies, but we don't own them today because many of them are trading above and sometimes well above our estimate of their intrinsic value. If that ever bursts the way it did in 2000, they could easily get back into our portfolio at a point in time. So that's how I think about returns going forward. It's I don't want to say there's an inevitability to it, but in a sense, what we're doing is it's not really market related because we're not letting anything we own run when markets are frothy. We're actually not owning it. And so we're preventing ourselves from earning really high returns. We're not going to have any home runs. But I think that de-risking process also reduces the risk that we underperform with enough time, over enough of a time period. It's not easy for an active manager, and in this environment, if you don't own the FANG stocks, the mega caps, we've managed to, but it's especially been tough in the last year or two, given how strong that part of the market has been.
Yeah, and now we have several questions here, but we're kind of running out of time. So they will be able to talk to you directly with the Turtle Creek. We'll send the information, but maybe one question. Although you bottom-up investor true and true living in these times, is there anything on the macro level that gives you pause? And if there is, how are you managing that in a portfolio context? And maybe the next question is just somebody's asking, what's the name of the debate? Is it the Monk debate? So these are two questions here.
So yeah, the Monk debate, it's M-U-N-K. I just get an email and I clicked on it. They do quite a number. I suspect if you just, they must have a website where it's free. It's just open debates. There have been some spectacular debates over time, and I think they're all archived on their website. But this one on COVID is very recent because I think I got it on Friday or Saturday and listened to it on the weekend. So the first part, Denny, I think I missed the very first part of that question because I was actually clicking on the Q&A and reading one. So you could just, maybe the first part, it's anything that's changed in the macro?
Although you're a bottom-up investor true and true living in these times, is there anything on the macro level that gives you pause? And if there is, how are you managing that in a portfolio context?
So if you'd asked me that a few months ago, I would have said the inability of America to get a handle on COVID cases that was really giving me pause, and it was frustrating to witness. And it's not to say that it's really improved much, but I think that the evidence and the science coming in now in terms of what the true fatality rate is, because of course COVID, all the serum tests are that it's much more prevalent in the population in different countries than you would expect just from people having symptoms or having been tested. So I'm less concerned about that, call it macro risk going forward in terms of the economy. I mean, I guess the only thing, and again, these are always such long-term issues, but the government spending and is there a risk that it changes, does that change human behavior? I can only speak as Canadians. We're actually maybe North American, but especially more with Canada, the number of people who have said how much difficulty they're having getting some of their employees back or even hiring people because of the government largesse. I mean, it's one thing to act correctly in the midst of the pandemic. it's quite another thing to just continue that at a point where you lose incentive for people to actually work. And I think there's, of course, less risk of that in the US than in Canada. So around the edges, I worry a bit about that. And then, of course, how are we going to pay for all this? Will US corporate taxes have to go back up? But the reality is, as bad as things are right now with the pandemic, if you step back and have an historical perspective in the world, things are, Trump aside, things are not all that bad. And so, and I'm in the midst of a Churchill biography, and you just get reminded of how terrible things have happened and how tough the world is being compared to what we're experiencing in 2020. So, but most importantly for us, I think, and this is and the question started with, even though you're a bottom-up investor, I've seen it over time. We saw it in the Great Recession in '09, how our companies navigated through that. Some that we still own, like the Factory Automation company, the Montreal-based trucking company, how they dealt through the Great Recession and maneuvered. Premium Brands, our food company that's based in Vancouver, and we still own those companies, and we're watching them deal with this environment even better. And so I think that it's a long way of saying there's really nothing in a macro sense that I'm worried about for our companies. What was most upsetting for me in the March crash was my investors seeing a unit price that's down when we didn't think the value of what we owned had really been impaired as a result of COVID. And yet they can't see that. They can hear me say it, I said it, but they're just looking at a stock market crash, and a bunch of them were, as you would expect, very upset and worried. And many of them still are. But from our standpoint, our belief is if you identify those remarkable companies that maneuver through any environment that's thrown at them, and then we do our job of making sure they're still doing that, and do our other part of our job of making sure our portfolio is as attractive as it can be from a multiple or valuation standpoint, I think that's a good place to be regardless of what happens going forward.
Great. So it's been very interesting here. Anything else, Andrew, that you'd like to add?
No, I don't think so, Benny. I mean, you've asked really good questions. This has been a great discussion. I wish we'd been able to get to some of the questions from the audience, but as you say, anyone feel free to reach out to us if you have follow-up questions or want to have a call. We'd be delighted.
Maybe quickly, the questions here were more about the Canadian market. If you feel Canada is cheaper than the US, and what are your thoughts about the rush of SPACs, IPOs? In the USA, 40% of this year IPOs. I didn't understand that question, but they're asking basically about that. So that's basically maybe a question you can also address.
So yeah, so I mean, look, we don't follow SPACs. There have been some in Canada. It's not a new vehicle. It just seems to be in vogue right now. There was a Wall Street Journal article the other day that I read about the Bill Ackman doing one, and some will work out, some won't. It's not something that we would ever look at. We're looking for long tenured management. We're not looking at things that are quote unquote a deal, if you know what I mean. And in essence, SPACs are a different way of funding a acquisition or a private equity version. So it's a niche area of the market. And we also typically don't, and we do in Canada a little bit, we don't look at IPOs. We're happy to wait until no one's paying attention to the company rather than at a time when there's a real focus and everyone's looking at the company. So IPOs are not a place we spend any time on. And the question is, the Canadian market cheaper than the US? Probably, but what I can tell you is that, you know, again, I'll keep coming back to it. We only know about 100 companies. So don't ask me if Tesla is a buy or not, because we've never looked at Tesla. I do own a Tesla, and it's remarkable. It's a remarkable vehicle, and it's extraordinary what they've done, but I can't opine on whether it's overvalued or not. And so what I can tell you is, of the 100 companies that we've identified and that we have a view of value, yeah, I think the Canadian ones, if of the 100, 40 of them are Canadian, maybe 60 are US. The Canadian multiples are probably a little lower. And yet, in the main fund, that is a mix of the US and Canadian companies, today it's 55% US and 45% Canadian. So it's not, and maybe another way to come at it, we have a Canadian-only fund with 25 Canadian companies. We have a 25 US company, US-only fund. When you look at those multiples, the multiples are only a bit lower on the Canadian side, but they are a little lower. It's what I said earlier. When a company's highly regarded enough, like a Couche-Tard, we don't see any difference in valuation. And the exceptions will be TFI, as I mentioned, when it's listed only in Toronto and there's nothing to compare it to, and then it gets listed in New York, which happened early this year. It's now getting compared with the other trucking companies. So that can happen in a one-off basis, where the Canadian market's got one of something and the US market has 10, then those 10 would tend to would trade at a higher multiple, because there's an analyst that actually covers the whole space, if that makes any sense.
Great. So we will send information on how to get in touch with Turtle Creek. It's been very exciting, interesting discussion. So thank you for being with us today. I will just tell you that the day after tomorrow, we have a discussion with somebody that I'm sure you heard of, Paul Desmarais.
Sure.
So from, of course, next generation of a very known Canadian family, Power Corp. And we'll be talking about innovation, technology, and entrepreneurship. He's next generation chairman and CEO of Sager Holdings, executive chairman and co-founder of his fund, Portage 3 Ventures, and chairman and co-founder of Diagram. So that's going to happen the day after tomorrow. So everybody are welcome to join. It's going to be a special discussion, also because it's my birthday. So if anybody plans to do anything, that's the time. You get 2 days to plan. So thank you, and I hope to see our tri-state families next week with us. Some of I know already who's coming next week to the World Trade Center, and it's been great. So Andrew, keep safe in Toronto, and thank you so much for joining us, and we hope to see you all later on, and thank you.
Great. Thank you, Danny. It was a lot of fun.
Thank you, guys.